if you go back to June, you can see that the market has found this 135, 140 middle part that it oscillates around over the last 3.5 months, 4 months. And that's hard to trade. It's not easy to trade that. So if you're day trading that stuff, okay, it's still not easy, but it's sort of the environment that people want. They want that movement to sort of be able to make these quick moves in and out. If you are expanding over time a little bit, it becomes a little bit challenging. Okay, it becomes challenging. And so, the best answer, if that's what you're doing, and essentially I do some of that, right? I'm not day trading. I'm not trying to catch the next thing, today, but because I'm looking at time and because I see the market just oscillating up and down, let's call it 7-8%, that's very difficult because when you're buying options, you're buying time.
Yeah.
And if you're buying out of the money options, you are buying a large move. And if we're not getting this large move and it keeps going up a little bit and then down sharply, but then finds a base, comes back up, and it's narrowing it seems like it's starting to narrowing the highs and the lows a little bit, that just becomes hard. You have to some extent wait it out, or you can narrow your time frame and find things that are, if you focus on 8 weeks, you start thinking about things on 2 to 3 weeks, right? Because 8 weeks might be just too long. You're paying too much for time, and you're going to get chopped around as the market whips up and down 6%. So that's what I would say. It's the best advice I can give to people who are trading this environment. Day trading, not easy, but it has a lot of swings. And you would have to, again, my best advice is to lower your contract size or the amount of money that you're putting in a trade, because the volatility has just almost doubled. Okay, so on a volatility basis doubling, when using options, your P&L is going to be flying around. So if you were used to P&L of depending on your size, but if you of trade, if you're used to P&L of a couple of $100, that might be $1,000 up and down swings, and that could cause problems between the ears. That I always tell you got to take care. So that's what I tell people. I say lower the amount of dollars you're putting in, because the volatility has just got higher. Same thing with selling. So that's buying. Selling seems easy. You just keep selling. But what the market is doing, and yesterday was a great day, was if you were selling the Iron Condor, if you were selling put spreads or you're selling call spreads, and you thought that was easy yesterday, it was down big, challenging your put spread, probably causing a lot of stops. People generally are not paying up to buy those call spreads, and the thing ripped back 2.25% or whatever it was, and that hurts people. So it's a dangerous environment. The volatility is up, and it's dangerous because in the market, the way I think about it, the market is trying to find a direction, and it's trying to leave the most people behind, because it's about to make a big move, is what the market is saying. It might be up. There's some people saying we're going right up to 600 in the SPY or higher, and there's people saying we're going to crash. But the market is, I call it shaking the monkeys off the tree, right? That's a term used on Wall Street. They're shaking the tree here, it's because there's a lot of hanging around traders, hanging around investors that are just hanging around. And the market's not going to let everyone win, so it just starts shaking the tree violently to get people off the tree, and then it's going to shoot. Once they got 80% of the people off the tree, so people are probably thinking about it, right? The crowd, but they are not going to allow everybody to win. Oftentimes it happens before a really sharp down move in the market. Because people start buying puts. Like at the end of the day, the definition of a crash is that no one wins, or very few people win. That's by definition. You can't have a crash and have everybody in the world make billions of dollars. It's not a crash. It actually wouldn't go down if that's the case. And so a crash, by definition, the way the game is set up, is when most people lose. So if everybody's buying puts and everybody's sitting there going, it's going to crash, the market is not going to give it to them. It's going to surprise them at some point when everybody just gives up and says, you know what, I'm not buying. And we got to that point. Then the market dipped down 10%, came back up. Now people are like, oh my God, there's this crash coming and buying puts. The market's, it's not that easy on the downside. It does not like to pay people on the downside. Mm-hmm. So that's the best advice I can give you.
I think I'm already felt from that truth. So I wonder how long this is going to last.
It's shaking it hard. It's shaking it hard. It's shaking it hard, and that is the market in a cage rattling this thing, saying I'm about to break out or break down in a big way, and I'm not going to allow people to make a lot of money on whichever way I decide to go. That's kind of the way I think about it.
Okay, how long do you think it's going to last, this uncertainty, or is it stay there?
You know, it could. It's already been 4 months, and you see these moves up and down from June to July and August, straight back down. August back up. But I mean, it's incredible. It's incredible. And then there was something on there was an article on Zero Hedge. And it asked. This is a great. It's a great article. You should look it up. But it basically showed how many times the NASDAQ was down 1.5% or down 2% and up on the day 1% or more, down 2 and up 1 or more. How many times does that happen? I forget what the exact numbers were, but it doesn't happen a lot. It did not happen a lot. And where it did happen was during the train wreck in 2000, when the NASDAQ crashed. That's when things, and again, the same thing I'm telling you, that's where I learned it from, because it's impossible. It is impossible to almost trade these things. You have to be very methodical with your, we have to be very methodical with your exits, because just when it looks like it's going to crash, it shoots up 2%. Yeah. Just when it looks like it's going to go higher, it just crashes. And it did that for months back in 2000. So they have a chart that highlights all the times that NASDAQ was down 2% and then up 1% on a day, or vice versa, whatever it was. And it doesn't happen a lot, but it happened a lot during that time in 2000. Incredible. And I lived it, and I'm telling you, it was the first time I've ever experienced anything like that. Had my head spinning, and it went on for months. And but the NASDAQ was down 80% by the time it was over, about a year later.
You were in charge that time. You were working as a hedge fund manager.
I was working at Bank of America. Even worse, because the hedge funds were coming in, and I was putting everybody up, and nobody knew where it was going. You know, it was chaos, and it was driving people absolutely crazy.
I hope we don't experience anything like that, but it would be beneficial to just be aware of these things are real. All right. So this is actually aligned with our topic today. So we will dive into that. Before that, I will look at the chat. Jim says, as zero DTTs are the thing these days, will you focus on that any point today? We can make another.
We can start. We can start there. I mean, that's an easy one. I mean, look, zero DTEs are really, to some extent, it's glorified stock trading with massive leverage. You know, I would not concern yourself with the Greeks. Honestly, they play very little role because everything is moving so fast. Most day traders, most of these zero DTE day traders are in and out within 20 minutes. Very few are going to feel the effects of, you know, this time decay of delta. I mean, it's just moving so fast. People are buying something for 50 cents and they're trading it for, you know, 80 cents. Maybe it might be 50, 60. And then they wait and they buy 55 and they try to sell 70, or they leave a little bit and they try to catch. Yes, there is time decay. But the way to get out of the time decay is as part of your process in zero DTE. You should have some expectation up front before you do the trade, which is what everybody's should be doing anyway. But I'll say it, you have to have some expectation of where it's going to go. And that expectation should sort of be how long you will be willing to stay in the trade. Meaning, I don't know, we'll take a SPY or SPX, whatever it is. But if you're saying on the SPY, it's 5. Where is it now? I don't even know. 5. Let me look quickly. shooting up here, 557.5. So if it's 557.5, and you're saying, okay, I'm going to buy some options. It's one day. There's 3 hours left, 2 hours left. Yeah, there's decay, but the real question is simply, is it going to 59 or is it going to 50, back down to 55 at the end of the day? You must, as you get closer, so let's call it from the afternoon to 4 o'clock, you have to get really, really specific as to where you want to go, because that's when time decay is going to eat you up. And that's when the gamma, okay, the gamma, which we don't even have to talk, no, but essentially gamma is the leverage. While it becomes very high, most of the time, the delta hedging starts crimping the movement of the option, of the stock and of the option. And so someone like the market maker, like a Citadel, they're trying to make money. If there's a lot of people buying these things, if people are selling them, but they have all the cards, they're seeing everything. So positioning is also very important. If you can find different ways, and there are some ways to sort of gauge, are people long, are people short, are people betting for the upside, are they going for the downside? Citadel, again, they hold a lot of the cards, and they are going to, it's not Citadel, but I think it's their AI. So it's an AI machine that sees everything and can push around the market, causing people to sell and then causing the other people to buy, and then they can push the market back up to hedge, and all it does is it just, people who bought the calls, now they're selling it, and they're selling it because the stock's going down, and as the stock's going down, people buying puts, then Citadel takes $100 million to buy the market, and the market starts going up, people sell the puts, they go back into the calls. And so this AI machine, because it's got so much information, it's a beehive. It knows exactly, it looks like chaos on any individual 10 people, but when you're talking about 1 million people watching the market, it's a beehive. It knows exactly, where the queen bee is, and it knows exactly how many bees are going to be around the queen bee at any given time. That's what the AI is doing, and it makes it very, very difficult. So you can get lucky and catch a big move, but if you've done it long enough, if you've played the zero DTE long enough, that before it makes that big move up, it usually, I would say 80% of the time, it sharply goes the other way, because everybody sees it going up, and everybody starts. If you see it and I see it and everybody else sees it, we're all positioning ourselves. This thing's about to explode, and Citadel is the master puppeteer. That he's puppet master. He's basically looking at it, going calls. It's 1 o'clock in the afternoon. There's not many things. We could take $200 million and push the market lower sharply. Boom, hit it hard. And all of a sudden, you're going to see everybody start selling their calls who are stopping out. That's going to cause the market to push lower. Citadel is buying back some of that stuff. The AI is buying back that stuff. And they're also, and that's also getting them their deltas, right? The call options against the short sales of futures is getting their deltas. So it's a machine that is, it's hard to beat. It's hard to beat. It's almost like
how we can beat this machine, or how was it back in time?
There was no machine back in time. It was a lot. This has gotten to be a crowd. This is human emotion live on the screen. And it's very, very difficult to beat it. And if you have all the cards and you see all the positioning, that's the biggest market maker in the world. He sees everything. I mean, all of a sudden I see calls. I'm short the calls. Where do I want the stock to go? I want it to go down. Okay. They have billions of dollars. So they just hit the thing with $1 billion sell program. Boom. The market goes lower. All these calls, they know probably there's 1 million options. There might be 100,000 call options that are long. They know probably within 1,000 contracts how many there will be if the market goes to this level, this level. That's how good the AI is. That's what the AI is programmed to understand, right? How to win a game where everybody's positioning. It's like playing poker at the table, and you're saying, oh, okay, I can see, 5 people's full hands, and only there's 10 people at the table. I see 7 people's full hands, and 3 people I could see one of their cards. Can I win that game? Man, that's impossible to lose. How do you think they make billions and billions of dollars? Why do you think they pay to see all the flow? They pay money to see all the flow. So if you think about it, it's not really Citadel or some person or Kangaroo. It's just AI. It's just AI that has gotten the information and is doing this thing where it's a game of poker essentially, and they see all the cards, most of them, and it's just hard to beat. So you got to outsmart the crowd, which is very difficult. It's not easy.
Or we need more regulation.
Yeah, but I don't even think that's going to be able to do it. That, you know, in this scenario, I don't think that's going to be able to do it because it's a free market. There's people playing, you know, and they have the ability to hedge. They're trying to hedge. They literally are trying to hedge, although I don't even think they hedge. People just buying calls, buying puts, buying calls, selling puts, buying calls, selling calls, selling puts, selling, but just back and forth all day. And their machine is just basically going, okay, fine. Millions of orders are coming in. You know, and the thing's going up and down, up and down, up and down. And then all of a sudden it starts tilting to like everybody's getting long calls. So what do? Okay, we got to get everybody out, hit the market, surprise the market, hit it. Right now, they also could see that if they can't do that because they're trying to hit it and the market's bullish, then they might just flip it and say, no, we actually got to get long here. Right. So these are the things. And I mean, I can only describe in a simple sense how it works. But that is the simple way. There's so many other things that they're doing, some of which that I can visually see, like moving the implied vol around as well. We talked about that. They can shift if everybody's long calls, right? What can they do? They could just shift the bid offers lower. So first they shift the bid offers lower, then they sell the futures. And what does everybody do? Everybody starts selling calls at the lower bid. So here's your quick lesson on zero DTEs. It's not an easy game. It's hard. It's a glorified stock trading game, because especially if you're taking, we talked about the time frame. If you're taking the time frame from the full day, from 1 year to 1 month to 1 week to 1 day, if you're taking that time frame down to 5 minutes, there's no Greeks, there's no Delta, there's none of that stuff. There's you against the machine. That's it.
So why people are preferring zero DTT instead of just going with the margin accounts?
What's the simplest answer?
Less, maybe they want less risk, because like maybe in margin account they can get margin call.
Even simpler than that. What's the simplest answer? They want action. It's the most action you can get, and you can get high leverage. High leverage, high action, and yes, you can minimize your risk if you just want to bet $100, $200, and say, okay, here's my shot for the day, and I can win $200, $300, $400. Yes, that's a strategy. That's a way to think about it as well. So yes, it's high action, high leverage, okay, but you can get caught up in that, because that's where it's, you know, it's the old adage, you know, you never start gambling $10,000 on a sports game. You never start that way. You start with $1.
My first question is, how can traders use option strategies such as straddles, strangles, and iron condors to hedge against or profit from market volatility?
Look, I think some of the ways, I think they're the same ways. I think it doesn't necessarily change too much. You should think about timing of when you're looking at doing these, let's say, iron condors, or selling put spreads or selling call spreads. You know, the market is pretty whippy here, and you might just want to wait till it makes its first move. Sometimes the market makes its first move. People wait. It all depends on how people do these trades. There's no silver bullet that's going to tell you this is how you do it. But I would still say to you, on all of these types of trades, you should have some stop levels, right? And you shouldn't just say, okay, well, I'm going to put this iron condor, collect, 70 cents. And if I lose $4.30 on a $5 spread, something like that, you know, or I collect $1.50 on 50 cents on each side and lose $4. You know, you probably should have some stop loss, you know, because the idea is to not lose the whole thing and to keep playing the game. You know, if you're losing 4-1, you want to make that, you know, how many times can you make that before losing 4-1? So, you know, I think that selling premium is totally fine. The problem is that this market, it sort of understands when people are short and when people are long. Again, it's the market is you could see it. So yesterday, what did it do yesterday? It just killed everybody who had these types of trades on, because it killed them on the downside and killed them on the upside. And then you could see people rolling the calls, and that's why the market kept on going up, because it was like those zero DTEs. People think they're collecting 50 cents, and all of a sudden it's going to $1. They close those and sell more of the upside, and then it keeps going. They sell those, sell more of the upside, and it keeps going, and it keeps going for $6. You know, that hurts people. And so people get caught in that every once in a while, and then you give back 2 months of work or a month of work, and you're back to square one. So you just, you know, there is no real like answer. The answer, the best answer, is to reduce your size, reduce the number of contracts that you generally are trading. The volatility is expanded, and just there's better times to make money. If you want to trade the zero DTEs here, or the weeklies, or shorter term, just trade shorter amounts, as smaller. Say these things, the market can move 5%. And so you just say, all right, if I'm right and this goes down 3 to 5%, I'm going to make X, and here's my one bet. That's all I'm going to do. And if it goes up 5%, I'll add up another up top of one bet, and that's it. You know, but you have to keep your hands locked down to the chair and say, I'm just going to leave it, because you'll start driving yourself crazy. It'll go up 1.5%, and then you'll go to the bathroom and be like, all right, well, I lost $100, and you sell it before going to the bathroom at $20, and you come back in the bathroom and it's worth 500, and you're like, wait, what just happened?
Yeah.
So, you know, that's what you want to avoid. But I would say using the same strategies work, just lower the size. That's probably the easiest answer.
Thanks for that, Felix. It was really what we were looking for. The second question is, what are the key differences between implied volatility and historical volatility, and how can traders use them to identify mispriced options?
Is a factual number. So what you do is you can go to just, how do I calculate historical volatility online? I think Investopedia has a great one. It just, you can do it once and then you understand it. But basically what it's doing is it's saying, here's a stock. What type of historical volatility do I want? 1 month, 6 months, 1 year, 2 years. I take snapshots. You want to, it's sort of like the characteristic of a stock, the DNA of a stock. And I want to know how it's been trading in the last 2 weeks, the last month, the last 3 months, and the last year. Okay. I have stock prices. I basically take the daily returns. So day 1, day 2, then I take the daily return. So on column 1, you're going to have, let's say, 100 stock prices, closing prices. On column 2, you're going to have 99, one minus whatever you started, because it's going to be the difference between the two, the percentile. So it always works on percentages. You're then going to take the average move. Okay, so stock moves 1% one day, 0.5%, minus 1%. You're going to take the average move, and then you're going to take the difference between each day's move and the average. And you're going to square that to get a positive number. You're going to square that. And then you're going to do this quick calculation. You're going to add it all up. It's the variance, and take the square root. Go to Investopedia. You'll figure it all out. You'll see it. And that's how you get implied. That's how you get this historical volatility. The factual number. You can't change it. It is what it is. You could do it for 2 weeks, for 1 month, 6 months. Okay, so fact. That's fact. You're looking in the rearview mirror. You're looking at a stock and you're saying, this is traded like this. Now, implied volatility is a number that comes from this Black-Scholes formula. It's a black box. It spits out implied volatility. What does it include? It includes the premium, the option premium in that black box. The option premium is a supply demand function, right? It's a market function. It's, if everybody wants to buy it, they're pushing the prices up. The premiums go up when you stick it in, keep everything the same. The implied volatility that comes out is going to be higher. It's a direct correlation. Higher premiums, everything constant, higher implied volatility. It's basically saying people are paying higher because they think the stock's going to move way, way further from where we're at. Okay. So it is the best guess. The market implied volatility is the market's best guess of what's going to happen in the future. So we have factual information of what's happened in the past. And now the market is telling us, well, we think this is what's going to happen in the future. Okay. That is the whole concept of comparing the past versus the future. Okay. Mm-hmm. Now, if the past was a number like 30 and the implied volatility coming from the black box is 50, then what can we say? We can say 50 in the future is much greater than 30. Mm-hmm. Whoa, the market's thinking that this thing's going to move a lot. The industry would have you believe that you can determine whether that option in the future, this one that's coming right here that we're looking at on the screen, the industry will have you believe that you can actually figure out whether that option is cheap or expensive today. And that is not true. That is not true. It's only true if you are actually going to be this delta neutral volatility trader who works at an investment bank, okay, or an options market maker like a Citadel who's trading that way, but you're not trading that way. 99% of people are not trading that way, okay? What it does say, okay, to be very, very specific, it simply says this option, this 3-month option today, is trading higher than it has for the last 3 months. Because the volatility, the 3-month volatility over the course of the last 3 months was X. So it's performed like this, and you could take 3 months, 3 months, 3 months, these slabs of 3 months. It's performed like this in the past. Today, it's telling me that it's going to perform a lot higher. Does that mean that this option is now expensive and I should sell it? No. Okay? Because just because the number is saying a lot higher, that means the stock could actually go way higher than that. The reality is that no matter if you sold, so someone says, oh, well, I have these calls and I sold these calls at 50 volatility. And I sold them because in the past it was 30. And so it was 50. I wanted to sell them and I sold them. And I said, okay, well, if we went back to today and you saw 50 and it was 30, can you tell me that you're going to win or lose on that option? No. Yeah. What if I told you that, let's fast forward 3 months and the actual historical volatility that we calculate, because now we're 3 months ahead, we look back, if we calculate the last 3 months, 3 months ahead, if I told you that the volatility, the historical volatility is going to be 20, you just sold 50. Can you tell me whether you're going to win or lose on that call option by selling it? No, absolutely not, because there's a situation where the stock could just dribble higher, up, just slowly but surely, and go right through your strike and keep going. You wind up getting killed on the option. And yet, yeah, so what? The volatility was 20. You made on that, but you lost on the direction that went right through the strike. And so, you know, that is the problem. That is part of the problem that I'm trying to illustrate to people, that there are things being said by the industry because the industry's education was made up. We went through this last year, was made up from the 1970s, and it was made for market makers. How to make, this is education on how to make a great market maker. Well, nobody's going to be a market maker. They're machines now. There's no more, I'm going to be a market maker. It's machines. It's done. Okay. So that education, to some extent, you will hear now people say, because I'm out there very, very vocally saying, you don't have to know that stuff. And even Warren Buffett says, you don't have to know anything about the Black-Scholes formula. So I'm not crazy. I'm just the one that's actually saying it. And now you actually hear people say, oh, you should know this, you should know this, you should know this. You may not ever use it, but you should know it. It's like, it makes no sense, no logic. So that's why I've changed the education and the focus to risk reward, which is what we talk about. Yes, we do look at implied volatility. And if it's 50 today and it was 30, I'm going to look at it and I'm going to say, why is it 50? Okay, it's 50, but the option's worth $2. And I think that option, $2 is going to go to $10. Who cares what it's 50? I don't care if it's 80. If I have reason to believe that this thing is going to go from 2 to 10, and we're talking it's right around strike, a little bit outside of strike, it's probably a good bet. I just got to be sure that the stock's going. I got to be sure that the stock's going higher, and that option's going to work down.
So, as I understand, like volatility and also the historical implied volatility and the historical volatility are like indicators. They don't mean anything just by himself. We just need to understand the logic behind, not just trade based on those.
So I would say that Historical volatility is not really an indicator. Historical volatility is just a factual number.
Yeah.
Implied volatility is an indication of what the market thinks is going to happen in the future. Direction wise, now if you're looking at the overall market, like the VIX, direction wise, generally, the idea is when the VIX is high, it's because the market is in panic, is in fear, nobody knows. But it also could be high, after it crashes, and now the market just thinks this thing's about to shoot back up, or in front of election where they don't know if it's going to go up or go down in a big way. Volatility might be high, so it's just trying to gauge, is there going to be a big move or not? But generally, the thought is if it's high, people are worried, they have fear about a crash.